Hello, this is Camille Sams, your certified mortgage planner, and I wanted to just take a couple of minutes to talk to you about the importance of looking at all of your options when you're considering the down payment for your loan, and not just to do the knee-jerk reaction of I need to put down 20% to avoid mortgage insurance, or I have to make sure that I have at least 20% down regardless of what the cost is. And it's really important to talk to your financial planner, to talk to your tax accountant, and loop them in with your loan officer to really evaluate the cost of borrowing funds. Now, what does that mean? What that means is that if instead of putting down the full 20%, you only put down maybe 10% or 15%, and you avoid pulling out that extra funds from your retirement account, from your 401k, or if you're borrowing against it. Keep in mind, even though if you're borrowing against your 401k, you're not paying additional interest, you may not have a penalty associated with it, there's all that benefit, you're paying it back to yourself, you're still losing the balance of that account, and you're losing the interest that would be earned if it remained at the higher balance. So that's when we talk about the cost of borrowing funds. So if then you step back and you look out 10 years from now, after you've paid off that loan and you're looking at your retirement statement, you're not going to have as much as you would have had you not borrowed that money or withdrawn that money from your retirement account. Same thing holds true if you withdraw the money from an account, a retirement account like an annuity or an IRA that may have early withdrawal penalties. In some cases, they may give you, depending upon your account, they might give you 10 to 15% leeway when you're purchasing a home. But what if this isn't your first property? What if this is a second home that you bought previously a few years ago, and now you're buying another home again, and you don't quite qualify for that first-time home buyer benefit? So these are all things that you need to talk to your financial planner, your tax preparer, your accountant, your CPA, and loop them into your loan officer, because it may be cost effective to pay a couple of points, lower your interest rate. That could be, $6, $7, $10,000, whatever that amount is. It's most likely going to be less than the $50,000 additional funds that you may be taking out of your retirement account, the extra penalties that you will be paying. And not to mention, you also have to make sure that this will not increase your tax liability, because that money that you withdrew from your retirement account could be considered income. If you take it out of stocks, it could be considered income. So please definitely make sure that you're looking at the full picture. This is a benefit of working with a mortgage planner offers you. They put those ideas in your mind and say, hey, have you checked with your financial advisor about this? Does your accountant know about the tax implications of you withdrawing this money, what this could mean? Make sure you're finding all of that out. Because you rather, have that information up front than to find out later when you're getting that tax bill, because that's no bueno. Hope you're having a wonderful day, and I look forward to talking to you again soon.